All right, so I hope everyone joined to the lesson and you can hear me very well. So today we're going to start our new module that will be our final account preparation. That's a wonderful course, to be honest. Like if you ask me, like all this accounting stuff we have, like management accounting, financial accounting, taxation, payroll, all this area we have. So out of all of this area, this area is quite interesting, like financial accounting. And the financial accounting is all about our external reporting. So if we talk about like what is the difference between the financial accounting and the management accounting, the main difference we have of the financial accounting and the management accounting, that is financial accounting is mainly used for the external purpose, for example, for the reporting purpose. So when a company, a business, they prepare the financial statement like profit and loss account and statement of financial position, after that, what they do, they submit to HMRC and Company House. So they submit to HMRC and Company House. This is the regulation they have to follow. Now, when they submit to HMRC and the Company House or HMRC after that decide like the accounts is right or not after submitting by the accountant. Now this one kind of available to see everyone. For example, if today if you want to see how much is the net asset or how much is the liability of Tesco or Sainsbury or Lloyd's Bank or any of the company that is public limited company or private limited company, we can see it in a minute. So if you type on the company house like Tesco, company house beta, it will tell you like how much is the income and expense for them. So you can see the financial statement for any limited company. So this is kind of the reporting every company have to do. It's a legal requirement. So every company have to do and submit their accounts to HMRC. Now, on the other hand, the management accounting. So management accounting is mainly used for the internal purpose. So internal purpose means like we do not show our management accounting to anyone. So for example, if we prepare the accounts and normally we do not tell to anyone, this is our plan, this is our forecast. So management accounting mainly focus on the internal stuff, for example, the forecasting, the budgeting, the variance analysis, performance indicator, this type of thing. So this one only for the management, this one only for the management. This one is never looked at by the external people, like no one have access to see what is the management plan. On the other hand, financial statement or final account preparation, this one is preparing only for the outsider, only for the people who is not inside of the organization. So only for the people who can overlook us, only for the people who have a legal compliance over us. For example, HMRC, for example, the company house, sometimes the auditors. So for that reason, the accounts we're going to prepare uh, based on our data or information we have for the company, for example, uh, profit and loss account and the balance sheet. This one basically we're going to submit to HMRC. And the management accounts, whatever we prepare quarterly or yearly basis, we never submit this information to the external body. We never say to HMRC what is our plan and what is our strategy. We never tell to HMRC or company house. So this is the main difference. So if someone asks you what is the difference between the management accounts and the financial accounts, so you tell management accounts prepare for the internal purpose and the financial accounts prepare for the external purpose. So external purpose means the people from outside of the organization, they can see it and they can do based on their compliance. For example, if we have a legal liability to submit our accounts to HMRC, so we have to do it, but not the management accountant. This will be the financial accounts that we submit to HMRC. Now, in financial accounts, we have few parts. So in these books for the level 3, we might not going to see everything. We will see only the basic stuff here. So you're going to see our introduction to the accounts. So that will be like, for example, how many types of organization we have. For example, like if any of our friend, let's say one of the friends said, I want to do a business. So for example, any of the friend, let's say Shafiq decided to open a business. And Shafiq came to me and said, I want to open a business, but I am not really sure what type of business I should start with. So I need to give some advice to Shafiq. And before I advise him, I have to know some background. I have to know some plan. I have to know what is the goal of the business. So if Shafiq said, my plan to start with a very limited, like not a very big space, not very big investment, not very big employees on the company. So it's a little bit, I'll work, maybe one or two employee will work with me, and I want to make the business really simple. So if this is the plan, I will tell Shafiq, you will go for the sole trader. So sole trader is the company where one person manage the company. Maybe they can have one or two employee, but mainly it will be deal with the one person. So let's say if Shafiq said, no, I have few friends, so it's not only me. So I have three more friends, and we want to do a business together. So if this is the plan, we can advise Shafiq. Shafiq, you can go for the partnership. So the partnership will be allow you to do business together more than one person. And Shafiq have a plan to make the business really big at the beginning. So we can tell Shafiq better to incorporate your business. So in this case, you can make the limited company. So this advice will be depends on the person, different perspectives. If the employee, or sorry, if the person, if the owner of the business decided to make it really big, so they have to think about from the different point of view. If the person decided to open in very simple way, they can think from the sole trader point of view. So we're going to see all of this in chapter number 1. So in chapter number 1, that will be introduction. We have here organizations and their final accounts. So here we're going to see how many types of organization we have. As we said, we have a partnership, we have a sole trader, we have a limited liability company, we have a public limited company. So all of this we're going to see from this chapter. The next chapter we're going to see that is called incomplete records. Incomplete records. Incomplete record is quite interesting chapter. So if you've done few papers, or like at least one paper, like advanced bookkeeping with me or with anyone, you have some idea about the ledger account or the general ledger account. For example, for the sales ledger, for the purchase ledger, so you already know that how to calculate the balance CD and BD. So for example, if we have a T account, and we said we want to find it out how much is the credit sale. So let's say we have a sales ledger control account. So from here we set the opening balance, and from the opening balance we see what other relevant figure we have here. So let's say we said the customer paid, so we write it down here, bank. Let's say we have the sales return, then discount allowed, contra. So all of this information we have to record in order to find how much is the sale. So now for the incomplete record, the things will be a little bit different. So here all the information will not be given. So some information will be missing. For example, the sales will be missing. They'll give you the opening balance, they'll give you the closing balance, and they'll ask you how much is the sale. So one information, the sales will be missing. So this is the reason this chapter is saying incomplete records. So the records will be incomplete. The reason I said it is interesting because even if someone come to you and said like, how much sales you make for the last year? And if you said, I'm not really sure because I don't keep any record, or maybe you have some record and you forget the record. So you said, okay, no problem. Tell me how much was the opening balance? So what was the sales from the last year? And how much you receive from the customer? How much discount you give? And how much you get returned from the customer? So if you have all this information, then you can have the sales. Even though you never keep record for the sales, you can still find it out. So this is incomplete record. So sometimes when HMRC come to visit for a compliance visit to your company, they ask like, what is this, what is that, and they ask for the explanation. Sometimes you said, I don't have any record for that. On that case, HMRC might say, don't worry about it, just tell me the other information, we can find it out, how much was that. So basically, in the case if the record is incomplete, you can always find it out by using the different techniques. So it's very, very important chapter, and this chapter will contain almost 35 marks. So almost 35% marks will come from this chapter. So out of this 5 chapter from this course, you can see this chapter is quite important. So my advice will be, when we do this chapter, make sure you revise yourself once again, because this is a very important chapter. Then we have accounts for the sole trader. So here we're going to see how to prepare the accounts for the sole trader. So mainly we're going to see how to prepare the P&L account, that is profit and loss account, and also the statement of financial position. So you're going to see how to prepare the accounts for the sole trader. So after that, maybe if you have a friend or anyone who want to submit the accounts as a sole trader, you can tell them you have to include this type of information on your financial statement. Chapter number 4, we will talk about the partnership. So here we need to see what happens if more than 2 people together want to do a business, and how many types of partnership we have. So you're going to see all of this from chapter number 4, and chapter number 4 will tell us how to prepare the accounts for the partnership. That will be another important chapter. So we can say another 30 marks will come from this chapter. So from the whole book, chapter number 2 and chapter number 4 is the most important chapter. That will contain maximum marks in the exam. Then chapter number 5 we have, that is introduction to the limited company. So here only we're going to see the introduction. Only we're going to see the introduction. There will be not much in this chapter, because this limited company is one of the very, very big area. And this area is connected to other things. For example, if you know how to prepare the accounts, but if you don't know how to calculate the tax, it is not completed. So this thing is very, very relevant. If you know how to prepare the accounts, you also have to know how to calculate the business tax. So this paper you will see on your level 4 on AAT. When you do your level 4, you will see there is a paper called limited company financial statement. So you're going to learn everything from there. On top of that, there is a paper we have that is called business tax. So you will learn everything about the business tax. So from this level 3, it's just the introduction. From level 3, we'll just learn the introduction. And this introduction will not be very difficult, just to tell us what is limited company and how does it work, how we prepare the accounts. Not actually, we don't need to prepare an accounts for limited company. All right, so this is the overview we have for this course. So let's have a look what is the topics we have, and how can we start with chapter number 1. So let's move on to chapter number 1, and let's talk about our final account preparation. Some of you who joined today, if it is your first lesson, you can see the email I have sent it to you. That's my email. That is sajid333@gmail.com. So if you have any question for anything, you can email me. And some of you already come from the last lecture, so they already have my email. So there is no problem for that. How many lecture we'll have later? We most likely will do 4 lecture. Hopefully, in 4 lecture we'll complete this course. All right, so organization and their final account. We'll have a look, Vinol. If you send me an email, just resend it to me if I missed, so I'll have a look again. So organization and their final account. So let's have a look what we have in this chapter. So in this chapter, we can see chapter overview. So in the chapter overview, the first thing we're going to see are organization and their final accounts, and we have some different type of organization. So if we want to open a company, if you want to start a business, what is the way we have to open it? So the first thing we can see, we have sole trader. So sole trader, where one person will be in charge of the business. So owns and managed business. So obviously there will be one person who will manage this business. Then there is no requirement to file annual return. So annual return, so you don't have to submit your annual return to HMRC. When you open as a sole trader, the accounts is really straightforward. All you need to tell HMRC how much was the income, how much was the expense, and how much was the profit, and based on that you pay the tax. Tax as individual. Tax as individual. This question is quite tricky. Tax as individual. That means if anything happened with the business, if anything happened with the business, you will be personally liable for any debt. For example, if you take a loan from the bank and for some reason, your business cannot do well, so you have to close the business. So if you shut down the business, the bank can come to you and they can take your personal assets. For example, they can say you need to sell your car, you need to sell your house to pay the debt. So this is very, very big disadvantage for the sole trader. For this reason, so many people decided to open a limited company rather than sole trader, even though the sole trader have a lot of advantages. Even though when you start a company in sole trader, you can carry forward the loss. For example, you started business 2010 and you make a loss in 2010. So, and 2011 you make a loss again, and 2012 you make a profit. So whatever loss you make last 2 years, you can still cover this loss. So you can say, okay, whatever loss I made, so I can still offset from my profit, so you don't have to pay any tax. So there is a lot of advantages we have as a sole trader, but there is some disadvantage we have. So this one also we need to know this thing, but for this paper, it will not be very complex. It will be very straightforward. Okay. On the partnership, as we said, if there is two or more people decided to do business together, they can start with partnership. Now, the condition here is partner own and manage the business. No requirement for the annual return, but must produce year-end accounts. So they don't have to submit the annual return, but they have to produce year-end accounts. Ultimate liability unless LLP. This is very important to understand that. Unlimited liability unless LLP. So LLP is a limited liability partnership. LLP, limited liability partnership. Limited liability partnership. LLP, limited liability partnership. So if it is a limited liability partnership, so when you open a business, if you open as a limited liability partnership, that time your liability will be limited. That means you don't have to pay anything beyond your investment. For example, if you invest £10,000 on your business, and if the business is liquid for any reason, or if the business gone bust, or if the business is closed for any reason, you don't have to pay from your personal asset if it is LLP. Otherwise, if it is not LLP, then your liability is unlimited like sole trader. Your liability will be unlimited like sole trader. Tax as individual. In partnership, you don't pay tax as a company. For example, if you have a limited company, if you have other company, you calculate the tax total profit for the company and you pay the tax on that. But for the partnership, you do not pay the tax, the overall profit from the business. Rather, what you do, you calculate the profit of the individual. So let's say there's 4 partners. You calculate how much A have profit, how much B have profit, how much C have profit, and how much the partners D have profit. So you calculate the profit separately. So when you do our partnership, chapter number 4, we're going to see everything from there. Then the last one we have limited company. This one is quite popular, and almost every single people, almost every single person want to start the business with the limited company. The main advantage here is the liability is limited. Liability is limited. That means if anything happened with the business, you are not liable to pay anything beyond the investment. So whatever investment you make to the business, you are only liable to pay up to that amount. So if anything happened to the business, if you lose the money, you will only lose your investment, not something from your personal asset. So even if you took a millions of loan from the bank, and if you cannot pay it off, they cannot come to you and say, can you pay the loan because your business is closed now? They cannot say it. Whatever they have on the business, they can take from there, but they cannot come to you and they charge your personal asset. So this is the biggest advantage we have for a limited company. Then we have a condition. On the condition, we can see it says separation of ownership and the management. So the business and the owner are separate entity. Business and the owner are separate. So when it is a limited company, let's say this is your business and this is you. This is your business and this is you. So business and the owner are separate. So even though this person own this business and invest some money, let's say 1 million. So this person invest money to the business 1 million, and because of that the business is started. But still the business and the owner are completely separate. You cannot say the owner is the business. Owner is not a business. That's why the capital is credit and it is a liability. That's why the capital is the credit and it is a liability, because when the owner give any money to the business, for example here 1 million, if you give to the business, so business have a liability to pay you back this 1 million. And this is the reason capital is a credit. So business have a liability to pay you back, even though you are the owner, but you and the business is not same. This is called separate entity concept. This is called separate entity concept. This concept says business and the owner are separate. Now, of course, when you do a business, so you'll be the owner. So every time if you take any money from the business, we call it drawings. If owner of the business takes any money from the business, we call it drawings. So because of the drawings, the capital goes down. And every time if business makes any profit, that will be the part of capital. So if the business makes any profit, our capital will go up. If the business make loss, the capital will go down. Then the next one we have annual return must be filed. So annual return must be filed. So every year, every 12 months, we have to submit our information to HMRC. So annual return have two things. So obviously, like we understand there is two things we have to remember. One is called financial year and one is called tax year. So the difference between the financial year and the tax year is financial year can be anything. For example, if I start my business today, my financial start will be start from today. So let's say if I start my business on June, so from June I'll have to count 12 months to complete my financial year. But the tax year is always same. The tax year is always same. In UK, the tax year is April to April. So every year, 5th of April, 6th of April to 5th of April, this is the tax year. So basically, after the April, you'll get your P60, and that will tell you your year-ending income. So for example, if you work for any company, you will receive the P60 just after the April, because it will tell you your whole year income. So this is the tax year set by the HMRC. But on the other hand, financial year, when you start your business. So from the day you start your business, from that day, you have to calculate the 12-month income and 12-month expense, and you prepare the profit and loss account, then submit to HMRC. And you pay tax based on the financial year, not the tax year. Okay, the next point we have here, limited liability. We understand the point. We understand the meaning of limited liability. Limited liability means when your liability is limited. So if you invest something, you're not going to lose beyond of that. So from that point of view, your liability is limited. No one can come to you and charge your personal asset. So whatever you invested in the business, you are only liable to pay up to that amount. Then we have must comply with the Company Act. Of course, like when you open a company, you will get a corporation certificate from a company house. So you have to accept all the terms and condition. You said, I accept all the terms and condition, and I will comply all the company regulation we have. That means submitting the accounts, then submitting the annual return, then confirmation statement, all of the regulation, the Company Act comply, you have to comply with all of this. So you cannot just skip anything, because without this, you cannot open a company. And I think this is the only country we have in this world, uh, United Kingdom. Here you can start a business within 24 hours. So if you wanted to start a business from tomorrow, if you apply for the company tonight, hopefully tomorrow or either day after tomorrow, you're gonna receive all of your confirmation statement, like corporation certificate, share certificate, everything. So this is the only country. If you decided to start a business, you can start in 2 days. All you need to do, you need to apply. So company house, let's say you want to open a company, and the company house, like if you want to open a company, the charge is only like 16 to 18 pounds. So all you need, like spend 16 to 18 pounds and open a company. And once you have the company documents, you can start a company. You can start a trading straight away. You can start your bank account. You can do everything you want. So I think this is very easy. And this is the reason so many people want to start a business here, because there is not many regulation or not many barriers to open a company. All right, so this is the discussion of the sole trader partnership and the limited company. Let's go inside of the chapters. Let's have a look what we have there. Asim, you said like, so small shops on the high street submit annual return. Well, not really, because if you talk about all the off license or like the chicken chips shop, unless it is KFC, McDonald's, not like big, but they are mainly they are sole trader, so they don't have to submit the annual return. If they're a sole trader, they just submit like sometimes the year-ending statement, like how much they earn and how much was the expense. That's it. All right, so let's talk about a little bit what we have here. So we have advantages and the disadvantages of different company. You can read yourself this. It's not very tricky thing. So let's talk about a little bit some of the activities we have here. Let's see if we can solve it. Say which of the following statement is correct. Now, obviously partnership. Let's talk about a little bit partnership, even though there is not much thing in chapter number 1, because we have a full chapter for the partnership. That will be chapter number 4. Now we have two different type of partnership. Partnership, we have two different types. One is just a partnership, and one is LLP, limited liability partnership. So one is partnership, and one is limited liability partnership. If this is the only partnership, if you open a business as a partnership, so what will happen? Your liability will be unlimited. Your liability will be unlimited. But if you open as a LLP, limited liability partnership, that time your liability will be limited. So when you open a partnership business, you have two options. You have both options. You can open just a partnership, or you can choose limited liability partnership. So limited liability partnership is more secure from that point of view, like your liability will not be unlimited. So your liability will be limited. But you have to follow some company rules and act, because when you open a limited company, you have to follow the company act. So you cannot just like do whatever you like. So you cannot settle down your previous loss. So when you have a limited liability partnership, you have to follow this partnership act. So there you have to see like there is some annual return, the confirmation statement, all of this you have to submit. So your compliance will be a little bit more. Your compliance will be a little bit more, but you have a biggest advantage. And the advantage is your liability will be limited. So for that reason, so many people want to open this one. All right, so let's have a look. Let's read this question. Which of the following statement is correct about the partnership? So we know there is two types of partnership. One is unlimited, one is limited. The first one, it says partnership have a legal obligation to produce annual accounts. This is number one. Number two, partners are paid dividend from the partnership profit. Number three, some partners have a limited liability. So some partner can have a limited liability. Partnership can issue a loan stock to raise money. So out of these four, which one we think the right one? So the question is asking which of the following statement is correct. So which one you think is the correct answer about the partnership? So the partnership, yes, very well done, Alicia. Very well done, Amount. Very well done, Shafiq. Yes, all of you have the right answer. So some partnership have a limited liability. This is the answer. Femi, I'll tell you what happened. Why number two is not true? Because partners pay dividend from the profit. It's not really true, because when you open a partnership, you have a partnership ratio. So you split the partner profit based on the ratio. For example, one partner can have a profit of 50%, another partner can have a profit 20, another partners can have a 30. So obviously, it's not like a limited company. If we talk about the limited company, then you are right, because limited company pay the dividend from the profit, but not the partners. Well, the partnership have a legal obligation to produce the accounts. Not really, because annual accounts, the partnership don't have to produce. The reason is the partnership will be charged individually. So it's even one business, but the partners will be treated individually. So you will submit your income, I will submit my income, even though we are three partners. So we'll submit our self-assessment or self-return. So it's called self-assessment return. We have to submit by ourselves, not like from the company point of view as an individual, because it's a tax as individual. All right, Bletra. All right, so let's move on to our next activity we have. Welcome. So let's have a look. The next one, incorporation. Incorporation is when you incorporate company to the company house. So when you incorporate, they will give you a certificate. So when you incorporate a company, the company house give you a certificate. It's like certificate of incorporation. Here we'll have a company number. So company number, let's say 00253. So basically this one will tell you this is your incorporation certificate, and you are established as a limited company or public limited company, whatever it is. Unless you incorporate to the company house, you're not going to get the incorporation certificate. So this one will help you to open your bank account and to do anything like trading, LC, foreign transaction, anything you want to do. So company will ask you, like, where is your incorporation certificate? So incorporation certificate is a legal document. So that will help you to establish your business. So when the business said, like, let's say when there's a limited company, business can buy and sell asset by their own name. Remember that. So business can buy and sell asset on business name. For example, Tesco. Tesco can buy a car. Tesco can buy land. Tesco can buy a building on Tesco's name. So they don't have to find like who is the director or who is the owner of the Tesco. So Tesco don't need anyone to buy any asset. Tesco can buy the asset on Tesco's name. So business will treat like as a person. Remember that business will be treated like a person. So he can go to the court. The business can go to the court. Someone need to represent, but business don't need anyone. Business can go to the court. Business can buy the asset. So business will be treated like as a person. So that's why you see the shareholders and the directors, these people are die, but the business never die. Business always alive. Sometimes some companies are established on 1803 or 1753, and still the company is live. But the people who was running before, now another people running, maybe in future some other people will run the business. but the company normally don't die until you shut it down or close it. So that's why business don't need to make a contract on behalf of the business by someone. For example, if you want to make a lease, let's say you want to take a lease from the business and to the another company. So you don't need the person like who is the director, who is the owner. We need to write their name. You say no. The business said the contract will be the business and the other business. For example, if Tesco buy a land or Tesco take a lease, so the parties will be Tesco and the other parties, not the owner. Because some of the private limited or public limited company, they have a lot of shareholder. For example, if you think about Tesco, how many shareholder Tesco have? That means how many owner Tesco have? Maybe 5,000, 50,000, 5 million, who knows? So if you want to make a contract or if you want to do something, you cannot write 5 million people name there or 500,000 people name there. So that's why the business will not need anyone to contact on behalf of the business. So business will be treated like as a person. So let's read this one, incorporation. It says, which of the following is an advantage of incorporation for a sole proprietor? Which of the following is an advantage of incorporation for a sole proprietor? Sole proprietor, like let's say sole trader. You are a sole trader, and what is the advantage for you? What is the advantage for you to make your company incorporate in the company house? So getting a corporation certificate. So rather than stay as a sole trader, if you incorporate yourself, so that means your liability will be limited. This is the biggest advantage. Remember that incorporation will give you the favor or give you the preference, make your liability limited. So if anything happened to the business, no one will come to your personal asset. This is the biggest advantage of incorporation. Let's have a look. The first one is say sole proprietor will no longer have to pay personal tax. That cannot be the right answer because it is impossible. You don't have to pay the tax. If you live in this country, doesn't matter you are sole trader, not sole trader, personal or impersonal, partnership or company, you have to pay the tax. So that cannot be the right answer anyway. Sole proprietor will have a greater control on the business. Obviously, this is true, but in the company, you have to look for something that is more advantage. The business will operate in compliance with the Company Act. Okay, the sole proprietor has more protection in the event of liquidation. So this is the one we're looking for. Even though some of the advantage we have in the top, but this is the biggest advantage we have. So the sole proprietor has more protection in the event of a liquidation. Liquidation means when you close the company, when you seize the business. When you seize the business, when you shut down the business, close the business, so that time no one can come and charge for your personal asset. So this is the biggest advantage they got if they are incorporated. If they're not incorporated, they will sell your personal asset and they'll take the money from there. All right, so let's look at our activity 3, limited companies. So here they're saying which of the following statement regarding limited liability is correct. So what is limited liability exactly? So let's have a look. What is our limited liability? So the limited liability we have here, the first one is says a company may only have a certain prescribed maximum liability on the statement of financial position. The shareholder of a company are protected in that they can only lose the investment in the company should the company fail. So if the company fail, they will only lose their investment and they're protected from that point of view. I think this is the biggest example of the limited liability. So if anything happen, if the company fail, then you can only lose your investment, nothing else. So whatever invested on the company, nothing else. This is the reason sometimes we see some biggest businessman, they said they are bankrupt. Sometimes we see on the newspaper they said he's a bankrupt, but this person still have a £1 billion houses, they have a very expensive car, they have their private jet, but we see their name on the newspaper and they said he is a bankrupt. So sometimes we think How it is possible? The reason is they are limited company and they are protected. They have protected their personal asset. So obviously, because of that, no one can come and take their personal asset. Okay, so let's have a look. Our next point, we have the Company Act 2006. So far after 2006, there is not more many change for the Company Act. Still, we are follow our Company Act 2006. So the last update we have for the Company Act 2006. So here we describe the duties and the responsibilities of the directors. So duties and the responsibilities of the directors. Duties and the responsibilities of the directors. Now, the directors, who are the people? Directors are the people who run the business actually, who direct the business. For example, if someone run the bus, and if I said, who is the director of the bus? So we're going to say, the driver, he's the director of the bus, not the owner of the bus. So sometimes we have like a different confusion. We think like the director may be the owner of the business, but he can be or he cannot be. Director can be the owners of the business or cannot be the owner of the business, because the director is the person who direct the business, who run the business actually. So director are the full-time employee of the business. Directors are the full-time employee of the business. So director can be part of the shareholder, cannot be, but it is not mandatory. Director has to be the owner of the company. No, it is not. Sometimes he can be, he cannot be. So directors are the person who direct the business, who run the business, he give the strategy of the business, who actually help to set up the strategy, the company goal, and everything in order to make the business more successful. So this is the directors. So the directors are the full-time employee of the company, and they have some responsibilities. They have some responsibilities because they are the top level of the management. So directors are the top level of the management, and obviously, if they're top level management, so if they are top level management, they have some more responsibilities. So the responsibility is to keep the accounts up to date, because we are starting the accounting. So we mainly focus on the accounting. The directors may have a lot of responsibilities and duties, but here we're going to mainly see from the accounting point of view, what is their responsibility. So keep the accounts up to date, keep accounts up to date, then maintaining the record, maintaining records. So obviously the director, they have to keep the records up to 6 years. Remember, in UK, it is a legal requirement. The company have to keep the documents, all the invoices, all this receipt up to 6 years. So if the HMRC come for the compliance visit, they can ask for up to 6 years. So they can go back up to 6 years. They cannot go back more than that. So for example, if you destroy something and like it is 6 years, more than 6 years old, HMRC cannot give you the penalty for that, because you said it is more than 6 years old. So I destroy it, I burn it, I shred it. They cannot say anything. But if it is within 6 years, you have to keep, and it is always have to be available for the inspection. HMRC can come anytime and then ask you, where is that paper? Where is this paper? You claim some expense. Where is it? Where that invoice? So you have to make sure the documents will be kept in the secure place up to 6 years. And top of that, their responsibilities is to make sure the company is running smoothly, all the strategy are followed. That will be the best interest for the company. Now, the next thing in the exam, they might ask you, do you need like director to make a contract on behalf of the company? The answer is no. You don't need the director to make any contract or buy any property or buy any asset. So directors' names you don't need there on the contract when you buy a asset or when you make a contract. So the company itself is enough, because we said the company will be treated as a person. So company will make the contract on behalf of the company, not behalf of the directors. So it will be on behalf of the Company, because director will go and come, but company will be always there. Okay, so let's move on. Let's have a look. What is there? What do we have more here? The next thing we have here, this is called NGO, or maybe non-profit making organization. So non-profit organization. The non-profit organization are the organization who run for not making profit, but they make profit. They make a lot of profit, but they do not run to make the profit. For example, NHS, for example, TfL, London Underground, Overground, all these government services like Royal Mail, this type of organization, they registered mainly as charities. They register mainly as charities or non-governmental organization, NGOs. So they might the government organization and they register as a charity, and non-governmental organization, for example, Save the Children, UNICEF, this type of organization who register also as a charity. These people are work for the different society and the community and for the country. So this organization do not run for the profit. They only run to they only run to the best interest for the community or the society, but not to make the profit. But even though they make a lot of profit, for example, if you think about TfL or London Underground, they make a lot of profit. But where the profit goes? If they make the profit, they reinvest the profit. If they make the profit, they reinvest the profit in the company. For example, whatever the profit they make, they have to reinvest the money to the business because no dividend can be taken from the charity. So if you make a huge profit from your NGO or from the charity, but you are not allowed to take any dividend from there. So only you need to do, you need to reinvest and to make it bigger or make it more useful for the company or more useful for the community or for the society. So you can change your structure, but you cannot take the dividend. All right, so let's talk about a little bit our next point. We have a next activity here. Let's have a look at this activity, activity 4. In this activity, we can see it says duties and the responsibilities of the directors. The following statement refer to action that may be required in relation to the companies. It says enter into the contract on behalf of the company. So what is the responsibilities of the directors? The first one, they said enter into the contract on behalf of the company, file the financial statement on time, prepare proper accounting records, present financial statement to be audited if applicable. Which of the above statement are duties of a director? So out of these 4, we have to choose which one is the part of our director responsibilities. So except this one, except entering the contract, all of these are the responsibilities of the director. And based on that, we can see number 1 is the answer. Very well done, Sadia. Very well done, Mark. Very well done, Betra, Alicia, and Sadia. Yes, we have the right answer. So this is the responsibilities of the duties of the directors. Now it says present the financial statement to be audited. Now audited means when the third party come to check your accounts. For example, so let's say we have a business, and this business have few people involved. The first is shareholder, who are the owner, shareholder. So shareholder are the actual owner of the business. This is the business. And we have the directors, who are the full-time employee of the business, who run the business, who run this business. And this shareholder can be a lot of people, many people. Let's say if it is a public limited company, there will be thousands of people of the shareholder who are the actual owner of the business. If you talk about Sainsbury or Tesco, they have thousands of shareholders. Now, In the board of directors, there may be only 10 people or 20 people who take the decision to run the company. Now, directors are not the actual owner of the business, they just run the company. Now, the question is what happens if the director does something wrong? Let's say all these 10 directors, they together and they said, we'll take a very good salary, we'll make our life better, we will do everything for our personal interest, not for the company. So what these people can do, the shareholder. So that's why the shareholder appoint another person from the outside. Shareholder appoint another person, his name is auditor. And this person, he come from the outside and he check everything on the company that made by the shareholder. So they go to the shareholder, said, can I have the accounts, can I have these, can I have this? So he check everything what make by the directors, and after that he report back to the shareholder. He don't report to the directors, he report back to the shareholders. So this person, the auditor, this person, the auditor is appointed by the shareholder, and of course after that this auditor report back to the shareholder, not to the director, so that shareholder can feel relaxed and feel okay, nothing going back to my company. And in UK right now, if the turnover is more than 10.2 million, I guess 10.2 million. So if it is more than 10.2 million, every year it is changed. So every year April, the HMRC changed the amount. So 10.2 million is the amount. If it is less than uh, turnover or sales is less than that, you don't have to prepare the audited account. But if it is more than that, if your income or sales or turnover is more than 10.2 million, you have to submit the audited account to HMRC, not the unaudited one. But if it is less than 10.2, you can submit the unaudited financial statement to HMRC. All right, so let's move on to our next bit. Have a limited liability partnership. Let's quickly read this one. Limited Liability Partnership Act 2000 allow the formation of a new type of legal trading entity. The limited liability partnership, despite the name LLP, have much more in common with the company than a standard partnership. The key feature of a limited liability partnership include must be registered with the company house. The name of the partnership must be end with LLP. The partners are known as a member. The partnership must file annual return and accounts where applicable, and audit is required. The LLP is a separate legal entity with all the associate feature of this email entails. Members are agent of the limited liability partnership. Members liability is limited. This is the one if you make the limited liability partnership. If not, then the liability is unlimited. Designated member are responsible for admin and filing. So the admin work and the filing work will be delegated to some employee, some members, not to everyone. LLP is not subject to corporation tax. The member therefore enjoy the some taxable status as a partner of a standard partnership. So when you prepare the LLP, it's not subject to CT. CT means corporation tax. As a company, when you open a limited company, then you have to submit the CT 600, that is called corporation tax. So in the partnership, you don't have to do it. The LLP must comply with the applicable provision of the Company Act. So some of the Company Act they have to follow if you open a limited liability partnership. The next point we have here, that is professional ethics. Professional ethics. Now, professional ethics is basically what is annual return? Annual return is basically the full accounts. So if I say the accounts, so how many parts we have in the account? So normally we said accounts or annual return. So this have some few parts. So number one, we said profit and loss account. Number two, we said SOFP, statement of financial position. Number three, we called it cash flow statement. Number four, we called notes to the accounts. So sometimes we send a statement of change in equity as well, But this is the main two bit: statement of profit and loss account and financial statement. So if you are with the partnership, you really don't have to submit this to HMRC, because you will be charged separately. For example, we have A, B, and C. So all of you will be charged separately to HMRC as a tax purpose, not as a company. So you pay tax separately, A, B, C, based on your profit, based on your income. So you don't have to do something as a whole. All right. So let's talk about a little bit about professional ethics. Now, professional ethics, this is kind of the judgmental thing. Ethics is always judgmental. So ethics is not something illegal. So obviously, like sometimes we have to understand the difference between the illegal and the unethical. So what about the tax rate? Each partner depends on the investment. No, it is not depends on the investment, or same is depends on the income. So for example, if you have income, you have a three type of income. So you can be three type of taxpayer. So you can be have a basic rate that is 20%. You can have a higher rate that is 45%, and you can have additional rate that is 45%. So 20, 40, and 45. So you can be one of the taxpayer. For if your income is within 38,000, so under 38,000 pound a year, you'll be treated as a basic rate taxpayer. If your income is between 38 to 150,000, you will be treated as a higher rate taxpayer, that will be 40%. And if your income is more than 150,000 per year, then you'll be treated as the additional rate taxpayer, and your tax rate will be 45%. So it depends which category you fall in. All right, so let's talk about our when you go to the partnership chapter, we'll learn more about partnerships. So for the time being, whatever you learn is a very basic thing. So all the calculation, all the accounts, we'll learn from there, chapter number 4. Okay, let's talk about professional ethics. So professional ethics, as we said, like the ethics, and ethics is kind of the judgmental thing. Ethics is not a law. It's just like make yourself comfortable, like you are not doing something wrong. Because as an accounting, there will be a lot of opportunity to manipulate the things inside. For example, you show the different figure in the accounts. So for example, one of the client came to you and said like, I need some loan, I need a very big loan from the bank, and you are advising him like, okay, and the first year we're going to show a lot of profit in the income in the accounts, so that the bank will give you the loan. So this is unethical. So for example, if someone come to you and said, I want to pay less tax for the first year, and maybe next year I'll do the business, I'm not sure, but for the first year, can you make me pay less tax? Now, if someone asks you that, then you said, okay, at the first year, we're going to charge more depreciation. So maybe the depreciation rate is 10, we're going to make it 40. So our expense will be more and we'll pay less tax. So this advice is unethical. So something as an accountant, you will know so many things, how to pay more tax and the less tax, but you have to ask yourself, is it ethical or unethical? For example, when you go out from your home, you you can turn on your heater or you can turn it off. So if you are turn it on and you go outside and you come back, so no one can tell you like this is illegal. The police cannot come to you and arrest you because you turn on your heater and you gone outside. But it can be unethical because you are wasting the energy. For example, if you using the light that time you don't need it, so there is some work so you do that is not illegal, but that is unethical. So it's kind of the judgmental thing. How you feel, is it right or wrong? So as an accountant, we have to make sure we are not doing anything that is not unethical for the country, for the society. So obviously that's why even if you become the AAT member, or if I become a chartered accountant, even for me, every year we have to do the CPD. So when you become a chartered accountant, every year after the January, they'll give you a lot of CPD, and most of the CPD is depends on the ethics. So they want to make sure you are still ethical, so you don't forget everything. So they give you a lot of scenario, they'll give you a lot of questions, they'll give you a lot of real-time information, so that even if something on your mind, you don't do it something wrong. So this CPD, continuous professional development, this one you have to carry on always. As an accountant, you have to always do this. So this is the thing we have to make sure, like as an accountant, we don't do anything unethical. So professional ethics, we have some code. As a professional ethics, we have some codes that we have to remember. This is called fundamental ethical codes. So fundamental principle. I said fundamental principle. So let's write it down. Fundamental principle of ethics. This is the fundamental principle. So you cannot compromise this 5. So this 5 we have here: integrity, objectivity, then we have professional competence and due care, confidentiality, and the professional behavior. This 5 you cannot compromise for any reason. So first of all, we have to remember all of this, then we can explain what is it. So integrity means like honesty is the best policy. So you have to be always truthfulness and the honest. You have to be transparent. So when you work, you have to be always honest to your client and to your customer as well. Then objectivity, you cannot be biased. For example, you don't give a favor over another person. For example, let's say your friend is waiting on the queue, and you said like, you don't have to be on the queue because you are my friend. And let's say your family member need to do something, you said, okay, you don't have to come, or even it is like right or wrong, I'll do that for you. So you cannot be biased. So you have to be always fair to everyone. Then we have professional competence and due care. So you should have the expertise to carry on the work. For example, let's say you become accountant and you don't know how to do the payroll, and one of the client came to you and said, I need some payroll service as well, and you said, okay, I can do that, but you don't have enough experience or expertise to carry on this work, but you don't want to lose the client. So that what you did, you said, I can do that. So you took the client, and obviously you're not going to give the best service. So if it is the case, you don't do it. Let's say 31st of January is the last day to submit the tax return. 31st January, normally every year, is the last day to submit the tax return. Now, let's say before 1 or 2 days, one person or 2% came, said, can you submit my tax return and I'll give you double money. And you are very tight. You already have too many people to do, too many clients you already have. So, but you don't want to lose the money. You said, yes, I can do it. So like there will be hard for you, and maybe you will do some mistake because you will do it rush. So, but still you don't want to lose the client, so you will take the work. So this type of thing you cannot do it, because this is not your, you don't have enough resources to carry on the work. And the next one we have confidentiality. Confidentiality means you do not share the client information to anyone, no one. Remember that when you work in a company, when you work in a practice, you have a different type of partner. So one accountancy firm on one practice like KPMG, they can have like 100 partner, and every partner can have a different type of client. So even though you work in the same practice, even though you are working in the same company, you are not allowed to share one information to another accountant. So you can share with your group, with the team. So if you are the partner, let's say you have 5 employees who work with you, can share with them, but not to the another partner, because he have another client. Let's say you have a client of Tesco, and another partner, the Sainsbury is his client. So if you tell information, anything like from where Tesco buy the onion, so with the cheaper price, then he can tell his client. So this type of information, even inside of the organization, you do not share. So confidentiality, you do not share the client information to anyone, even though if you find it out, your client don't want to pay tax, your client is avoiding the tax, your client is doing something wrong, still you are not allowed to tell this thing to HMRC. So if you tell this information to HMRC, you will be in trouble. So never say to HMRC, my client said he don't want to pay the tax. My client may be involved with the tax evasion, so do not say this. So what you'll do, if you see your client is doing something wrong, all you need to do is tell HMRC, I am resigning. I'm resigning as an accountant from this client, but do not tell why. This is the confidential information. Then the next one we have the professional behavior. This is very important. Professional behavior. Professional behavior is like how you act to the client. For example, if someone come to see you in the office and you're just smoking, sitting on the chair, you're smoking, and your client will think what type of person he is because he doesn't look like professional. Maybe he come to see you in the office and he found you are wearing like the shorts and the t-shirt, so he'll feel like you are going for a holiday. So you think this guy in the office, he is sitting with the shorts, so he doesn't look like professional. So it will not only damage your personal reputation, it will also damage the reputation of your qualification body. For example, he will tell, I know an accountant, he is not professional at all. So he will tell first the accountant and then he said your name. For example, sometimes we saw some news on the newspaper. It says like one guy from the University of Oxford, he done this wrong thing. So not only this guy, he's losing his personal reputation. Also, the University of Oxford name is there. So this type of thing can damage your reputation and the regulatory body as well. So that's why you have to be always professional to your client, and obviously all of your people you meet for the customer or for any type of work you do with the third parties, you have to be always professional with them. So the next thing here for this, remembering for the fundamental principle of ethics, we always use one word that is called Dr. Pico. So we use this word, Dr. Pico, Dr. P-I-C-C-O. Dr. Pico will help us to remember the ethical fundamental principle. So we can say P for professional behavior, I for integrity, C for competence and due care, C for confidentiality, and O for objectivity. So if we remember Dr. Pico, and this Dr. Pico will help us to remember this fundamental principle of the ethics. All right, so let's move on to the next bit we have. In the next area, we have threat to independence. Like, what is the threat we have that can make us bias? So what is the threat we have? Because of this threat, we cannot be independent. The first threat we can have, it is self-interest. Self-interest. For example, you have a lot of investment in Tesco. And you are the auditor of Tesco. So you have a lot of investment. So you are one of the biggest shareholder for Tesco, and you are also the auditor of the Tesco. So what will happen because of that? So when you audit the financial statement, if you find a mistake, if you find an error, you will not try to disclose it to the public. Why? Because if you disclose it to the public, the share price of the Tesco will go down, and because of that, your investment will be affected. So your share price will go down, your investment will go down. So if you have a self-interest on something, because of that, maybe you will be not unbiased. Maybe you will be biased. You think like, because of this decision, I will be also loser, so I'm not going to do it. So self-interest is one of the threats. Then we have self-review. Self-review is another threat. Self-review happens when you check your own work. Let's say you are the accountant and you are the auditor. So if you are the accountant and if you are the auditor, you're not going to find your mistake. So basically, you are the accountant who prepared the accounts. And after that, you're checking your own work. So if you're checking your own work, you're not going to find any mistake. Even if you find a mistake, you're not going to tell to anyone. So this is a self-review threat. You should not check your own work. The next one we have advocacy threat. Advocacy threat is happen when you become an advocate for a person. So you giving the advice. So for example, if your client need a loan, you went to the bank with the client and said, here's my client, his company doing really good. I have next 6 years cash flow statement. I'm expecting a lot of profit will come from this company. So you giving the advice, like you're doing the advocacy for your client. You are not allowed to do it. You cannot be advocate for your client. Then the next point we have, that is familiarity threat. So familiarity threat happen when you become too close to your client. For example, if you have a client, and this client is you have for a long time, like say 5 years, 6 years, 7 years, you have the same client, and you become too close to your client. So for example, when the client have a birthday party, when the client have a son and the daughter, they have some program, they invite you and you go there, and you become too close to your client. So when you become too close to your client, then this familiarity trait rage, because maybe in future if something happened wrong, even if your client doing something wrong, still you don't want to tell to the people, like the client, so that he will be upset. So you don't want to tell your client like you're doing something bad, because he's too close to you. And sometimes maybe your client can request something that is not very right, so they can say, can you do this one, can you do that one, and you know this is not right, but still you cannot say no because he's very close to you. If this is the case, if he's very close to you, and that case, maybe that could be a threat for your independence, that could be a threat for your objectivity. The last one we have intimidation threat. Intimidation threat is happen when someone pressure you. When someone give you the pressure, someone said, I'm very powerful man, you have to do my work. So someone pressure you. This is called intimidation threat. Someone said, if you don't do my work, I will change you next year, so I'll have a new accountant next year. Say if someone said, you have to do my work within this time, otherwise you'll be in trouble. So any type of pressure, anything you have, this is called intimidation threat. So intimidation threat is happen when someone give the pressure to do the work. It could be, they can say like, if you don't do my work, I will change the accountant. They might say you, I'm going to reduce the price. So if you don't do my work, I'll go to the new accountant. So for any reason, if they give you a pressure, this is intimidation threat. All right, Adel, what you say, does it mean as an accountant, I would not be able to prepare accounts for a company I own? This is a very, very wonderful question. I never had this question before. Even I never think about it. So of course you can, because when you will be an accountant, then your company accounts you have to submit to the HMRC. But I can guarantee you, when you submit your accounts to HMRC, you will never do anything wrong. Because if you do something wrong, they can cancel your practicing certificate. They can cancel your membership. So obviously, if they do that, you cannot practice anymore. So this is very, very important. Like you can do something wrong with the other people because you think like this is not relevant to me, but you will never do something with your own company. All right, so let's move on. What we have here? Let's have a look. The next activity, activity 5, we have here professional ethics. Let's have a look what we have here. So true or false? So we need to identify what is true and what is false. Let's read the first one. The first one is saying confidential information. Confidential information should only be shared with the other accountant in your firm. Confidential information should only be shared with other accountant in your firm. So it looks like true because you work on the same company, but the answer is not true because you are not allowed to share with any other accountant, even your firm. So in one firm there will be a lot of accountants, so you cannot share your information to the other accountant. Don't think like we are work together, so they will know. No, you cannot share it. That will be false. The same audit team being sent to a client for several years can give rise to a familiarity threat. So if you send the same person same accountant to the same client for a long time, that could create a familiarity threat. Is it true or false? The answer is it is true, isn't it? If I send the same person long time, like 5 years, 10 years, to the same client, same accountant will work for him, so that will create in future the familiarity threat. Then the last one, they said gift from a client can be accepted as long as their value below £100. So, well, you don't take any gift from the client. First of all, even it is £100 or it is £10, doesn't matter. You don't take any separate gift from the client. So for example, if the client said, I'm very happy with the company, and they bring some sweet, or may they give you some voucher to watch some cinema for everyone, so this is maybe accepted. But if he give you something individually, so he want to make you happy for any reason, this is not acceptable. You don't take anything as individual, and you don't want to be like get involved of something like he give you something and to make you happy so that he can do his work, he can make done your work by you. All right, so ethics is really important for every aspect, not only for the accounting. In our real life, ethics is very important. You have to be honest, like when you work in a business or any sector, we have to be like shows our transparency so that people can trust us. If the people, if your client, if your customer cannot trust you, you cannot go really far. So it's very important, like your ethical principle is really strong. Okay, this is the end of the chapter number 1. So let's move to chapter number 2, and let's talk about our next chapter. The next chapter we're going to see that is incomplete records, and the incomplete records is quite a tricky chapter. I will not say it's a difficult, but it's a tricky chapter. So make sure you revise this chapter very well. As I said, like we're expecting kind of like 30 to 35 marks from this chapter. So you need to make sure you understand very well this chapter. Okay, in incomplete records, all you need to do, we need to identify what is missing, and we can work on that figure. So if something is missing, we have to identify that. So the first thing we have here, we can see markup and margin. Let's talk about a little bit markup and margin. Markup and margin. So markup and the margin both are basically the percentage calculate for the gross profit. So when we make a profit, we want to get the profit like the percentage. Let's say we want to sell something, we want to know how much is the profit inside. For example, if I said 100 is the sales, 100 is the sales, how much is the profit inside? If I want to know how much is the profit inside of this 100, I want to know, is it a markup or it is a margin? So remember, markup and margin both are basically the way we can calculate the profit, but there is some little bit different way we have to calculate the profit. The first thing is, all you need to remember, margin is calculated on sales. Margin is calculated on sales, and markup is calculated on cost. So when I said the sales is 100, and if I said the margin is 20%, so I understand 100 times 20%, so 20 is my profit. So that means it's a margin. If I said margin, then I can say my profit is 20, because margin is connected to sales. So margin percentage calculate on sales. But on the other hand, markup percentage calculate on cost. For example, if I said my cost is 100, and my markup is 20%, so my profit will be 20%. So problem will happen when in the exam they will give you cost 100, but they will not give you the markup, they'll give you margin. they'll give you margin. So there's a margin 20%. How much will be the profit here? So we cannot multiply here because it is a margin. Margin cannot be calculated on cost because margin is linked to sales and the markup is linked to cost. So we have to change it. This is the challenge here. So when there is a markup, if there is a cost, the life is easy. Just multiply how much is the profit. If there is a margin and if there is a sales, the life is also easy. But if there is a markup but there is a margin, obviously if there is a markup and there is a sales, and if there is a margin there is a cost, that time it will be a little bit tricky. So we'll see how we calculate that. All you need to remember from here, you can see on the margin is said gross profit expressed as a percentage of sale. So when I said margin, I can say sales is 100%. So sales is 100%, my cost is 80%, and the profit is 20%. So all you need to remember, when there is a margin, sales is 100%. When there is a margin, sales is 100%. But when there is a markup, then cost is 100%, not the sales, because sales is 125% if the margin is 25%. So if my margin is 20%, then my cost is 80% and my profit is 20%. Very simple. If it is a margin, if it's a markup, then my cost is 100% and of course my profit is 25%. So my sale will be 125%. This one we have to remember. Markup, sale is 125%, margin, sale is 100%. If we remember that, our life will be a little bit easy. But when you do some exercise, some actual question, we'll understand more. The other thing we have here, that is accounting equation. I'm sure all of you know that. That is our asset minus liability equal capital. This is a very old topic. We already know it, so should be fine for that. So let's have a look what we have here. On the incomplete records, all you need to do, we need to find the difference. There is a lot of explanation you can read yourself, but all you need to do on the incomplete records, we have to identify what is incomplete from there. For example, question number 1 in activity 1, let's try one activity, at least we'll understand what is exactly the incomplete records. So in activity 1, we can see here the question is asking calculating sales as a missing figure. Calculating sales as a missing figure. So they said the sales is missing. That means I'm a person, I have a business, and I don't know my sale. I have no idea how much is the sale. So I want to find it out myself. They said during the year ended 31st December 2009, a business had the following balance on the sales ledger control. Now we already know what is sales ledger control. Sales ledger control is a credit customer account. Sales ledger control is a credit customer account. From the sales ledger control account, we can identify how much is the balance outstanding from the credit customer. Then they said balance as at 31st December 2008 and 31st December 2009. So we can understand this is the opening balance and this is a closing balance. That's for the trade receivables. Trade receivables is the sales ledger control, is the same name. Trade receivables and the sales ledger control is the same story. Payment received. Payment received from the credit customer during the year total 39,204. So during the whole year, we have received 39,204 pounds from the all credit customer. Now the question is, how much is the sale? The requirement here is asking find the missing sales figure. The question will tell us what we are looking for. So we're looking for sale. We're looking for how much was the sale because I don't have a record for the sales. So let's find it out. We can see the opening balance exactly the way we did our previous all this ledger account. We're going to do the same thing. On the T account, we're going to say my opening balance, balance BD, we'll have a balance CD. And after that, our bank will become this side. Bank means how much we received from the credit customer. Then any sales, we'll record here. Then more or less, that's it. So let's have a look, the opening balance. Opening balance we have 1447. The closing balance we have 1928. The bank we received from the customer, that is 39,204. So this is the total story. So we have opening balance this 1447. The closing balance is 1928. After that, customer paid to me 39,204. I don't know how much was my credit sale. This is the question. The question said find the credit sale. So all you need to do the find the credit sale. This is called incomplete records. The records is not complete. So let's find the complete records. So all you need to do, you need to add this. So if we added this to, how much will be the total? So let's do that. So we have 39,204 plus 1928. So that gives us 41,132. Thank you, Osim. So we have 41,132, and we minus this one to find the cells. So you can say this is a balancing figure. We write it down B. That will give the balancing figure, and that will give us 39685. So the answer will be here 39658. So all you need to do, you can write here same thing. Balance BD 1447, bank 39204, balance CD 1928, and the cells is the balancing figure, that is 39,685. 41,136, 41,136. So that's how, before we have done our ledger account, we have seen like we always need to find the balance CD BD, but this time we are not calculating the balance CD or BD. The CD or BD is already given, but all you need to do, we need to calculate our difference. So the difference here is 39,685. So this is what's our credit sale. So if the question said how much is the credit sale, our credit sale was 39,685. This is our balancing figure. All right, so this is just one example to make all of you understand what is basically our incomplete records. So where the records is not complete for some reason, we can find the balance. So this is called incomplete records. All right, so Alicia, what you're saying, missing figure sells this. Yeah, Josheb, how are you to get the balance BD? 1947. It's not 1947, is 1447. Do my 4 look like 9? It's a 4. It's not 9, Josheb, it's 1447. All right, so that's it. So let's take a break, and once we come back, we'll start with the next examples. And as I said, this is kind of one of the tough chapter, one of the tricky chapter from the whole book. I cannot say it's difficult, but it's a little bit tricky. So all of you do your attendance, make sure you write your name for your recorded lesson, so that they can send you the recorded lesson. So make sure you write your name, and I'll see you in half an hour time. So we'll start 8 o'clock. All right, welcome back. Let's move on to our next activity. Let's try to do what we have here. So activity number 2. Here we can see they're asking calculating the contrast, V80 amount, and the cash balance. So they're asking for 3 things. So they're asking for contra, and they're asking for the cash balance and the V80 amount. So contrast, V80 amount, and the cash balance. So they're asking for 3 things. Now, of course, like I'm sure some of you already know what is contrast. So contra entry or contrast happen when the supplier is our customer. So for example, when I buy something from the supplier, I have to pay the money. So when the supplier is also is our customer, so they also have to some money. So rather than paying the full amount and getting whatever we're supposed to get, we offset each other. For example, let's say there is two-person. So this one is supplier and this one is customer. So one is supplier and one is customer. Let's say we buy something from him, £500, and he buys something from us, £300. So rather than we give £500 to him and take £300, so we can say you don't have to pay me 300, so I'll give you 200. So rather than I'll give you 500 and 300 back, so we can offset each other. So we can say, okay, I'm not going to give you 500, I'll give you the difference, that will be 200. So rather than give you 500 and 300 take back, so giving you 200 is the same story. So I said I'll give you 200. So basically the difference we are losing here, 300, this is called contra. Because on the bank, actually, we're going to see 300 is received from paid to the supplier. So ultimately, the due was 500, not 200. So on the bank, we will pay only 200. So that's why our sales will not be matched. Our sales will say the sales was only 200, but actual sales was 500. So to keep the sales on that level, we have to show this balance, and the difference we find it out with the contra. So this 300, we said, okay, this is the contra entry. So contra entry means when my supplier is also my customer. So rather than paying the full amount, what we do, we just find the difference and pay to him. So this is basically offsetting the account. So both account, the purchase ledger control and the sales ledger control, from both account, we offset the contra entry. So the first question they're asking for the contrast. The next question they're asking for the V80 amount. We already know how to calculate the V80. So V80 have a two side. One is the debit side, another one is credit side. All this liability, when I have to pay more VAT, then I have to record on the credit side. When I have to pay less VAT, I'm recording on the debit side. Writing on the debit side, that means reducing the liability. Recording on the credit side, increasing the liability. And the cash balance is all about how much money we have. So let's have a look at this question. Let's read this question so we'll understand more. For the contra, yes, Asim, we do that one. For the contra, we said purchase ledger control debit and sales ledger control credit. Okay, so this task is about the incomplete records and reconstructing the general ledger. So you are working on the accounting records for a sole trader for the year end 31st of June 2009. So we can see here we have some information. So sales, from the sales daybook, we have a credit sale. So total credit sale is 180. Out of 180, we can see 30,000 for the VAT, 150 for the net. So my total credit sale is 180. Total credit purchase is 96. This is the balances. 30 June 2008, 30 June 2009. So that's my opening balance and that's my closing balance. We understand it. Then we can see that trade receivables, that sales ledger control. We can see 22,000 is the opening, 47 is the closing. Then we have trade payable, 29,500 opening, 34,600 closing. VAT, we have 5780, the credit is opening balance. Bank, we have opening balance 83,456. So at the beginning of the year, we have this money on our bank. Okay, then we have for further information. Here we can see for the general expense, we have total 14,100. VAT is 2350 and the net is that. So all this VAT we will claim back. Even for any VAT we paid, we'll claim it back. The purchase you already have here in the top, so you don't have to reconsider again. What else we have in the information? On the bottom, we can see some movement from the bank. We said receipt and payment record in the bank. So amount from credit customers, we receive from the credit customer 140,300. We paid to our credit supplier 88,900. Rental income, we received rental income 10,000. Wages, we paid this one HMRC, we make a payment 11,800. General expense, we make a payment 14,100. This is the information we have. Thus, there is no problem for that. Let's have a look at the requirement. On the requirement, we can see they said sales ledger control. So find the contra, find the missing contra. Whatever the question said, we have to follow that. If the question said find the contra, we find the contra. If the question said find the sales, I will find the sales. If the question said find the purchase, we'll find the purchase. We need to read the question. The question will tell us what we're exactly looking for. Then we have a VAT control account. We can see the VAT control account. So the last one we have, they said find the cash balance. Assume there is no year-end adjustment. What will be the opening balance in the cash book at 1st July 2009? Okay, so let's start with from the beginning. The question first one asking find the contra. So doing the contra, we need to create our sales ledger control account. Let's do that. Sales ledger control. Sales ledger control. Number A. Sales ledger control. On the sales ledger control, the first thing we'll do to find the opening balance. So let's find the opening balance for the trade receivables. For the trade receivables, we can see the opening balance we have 22,000 and the closing balance we have 47,800. So that's fine. You're going to write the opening balance. So balance BD, that is 22,000, and balance CD, that is 47,800. Then after that, we need to see how much is the credit sale, because sales ledger control is all about how much is the credit sale and how much was outstanding. So sales ledger control will tell us the total outstanding balance anyway. So we have 180,000. This is our total credit sale. So okay, we say sales day book. Sales day book give us this information. 180,000 is the credit sale. And the next thing we're going to see how much we received from this credit customer. So let's have a look how much is on the bank. So on the bank, we can see we received amount from the credit customer. It is 140,300. So we receive 140,300 pound. So we said we receive 140,000. We're going to say bank 140,300. After that, all we need to do, we need to make a total, and the difference we'll find that will be our contra. So let's find it out. If I added the higher side, so should be this side higher. If I added this two, how much will be our higher side? 202. Thank you, Osim. So 202. This is our total. 202, 100,000. And if you minus this two from this one, this and that will give you the difference. And the difference will be contra. That will be how much? 13,900. So this is the one we are looking for from the question, because the question clearly says find the contra balance. So that's why the difference, I know this is the contra, it's not something else. Because sometimes you might think, how do I know this is the contra? So that means the question will tell you what you're looking for. What is the difference? They will tell you this is the contra. All right, the next one we're going to do the V80 amount. Let's talk about the V80 amount. VAT. Left-hand side is the debit side, right-hand side is the credit side always. This is by default. So this is the one. Left-hand side is always debit side. Right-hand side is our always credit side. So let's have a look at the VAT now. Let's talk about little bit VAT. On the VAT, the first thing I'll do, I'll need to do the opening balance. So let's have a look at the opening balance. How much is the VAT opening balance we have? So how is the bank? Okay, so no problem. So you can see here on the bank, they said amount owing from credit customer. So this is the money we received. The receipt and payment recorded in the bank account. So 140,300 we received from our credit customer. This is the money we received. All right, so let's talk about the VAT. So VAT we have 5780. This is our credit balance. Normally VAT is a credit balance. If you see the question, and obviously like if they don't say anything even debit or credit, you need to understand VAT is a liability. So it is normally a credit balance. So we're going to see VAT balance BD, that is 5780. Then we need to see how many VAT we have. If there is a VAT that will increase the VAT liability, we're going to record on the credit side. If it is decrease the liability, we record on the debit side. So if we make a sales, that will increase our liability. So you can see the VAT on sale is 30,000. So you're going to write this one, sales they book 30,000, because if I make a sale, I have to pay the VAT. Then the VAT on purchase. So if the VAT on purchase, we have to claim this VAT back. That will reduce my liability. So I'm going to write purchase they book 16,000. Then is there any more VAT? We can see on the general expense we have VAT. We paid 2350. This VAT also we're going to claim. So I'm going to say general expense 2350. And the last thing I'm going to check, is there any VAT I already paid? Because if there any VAT I already paid to HMRC, that will reduce my liability. So I can see HMRC for VAT payment, that is 11,800. So this is the money we already paid to HMRC. So that will reduce our liability. So you're going to say yes, this one I'm going to record here. So already payment from the bank, that is 11,800. This is the story of the VAT. So opening we have 5,780. Then we make a sales, the VAT is 30,000. We claim 16,000 and 2350 for the general expense, and we already paid some VAT. So writing in this side, that means reducing the liability. Writing on the credit side, increasing the liability. So all you need to do, you need to make a total now. So let's make a total. Which side will be the higher side? It looks like that side. So 35,780. Okay, no problem, Osim. So 35,780. The total is 35,780. And you minus this, and that. If you minus this 3, that will give me the balance CD. So balance CD, how much is the balance CD? 5630, 5630. I'm sure all of us, we did this VAT control account before as well. It's not very difficult thing. So all of you should be fine for that. All right, so 2 is done. So we've done the contra, done the VAT. Now we find the cash balance. How much money we still have on our bank account? Let's have a look at that. The question said, at the beginning of the month, we have this money. Bank is debit, so we said bank. Opening balance, the question said we have 83,456 pounds. So this is, let's have a look. What is the question is asking? The question here is saying we have the total record in the cash book for the year ended 30 June 2009. Okay, so receipt is 150 and the payment is 129. So during this period, my receipt is 150, 300. So this is the money you have received, and we make a payment. Payment is 129,550. This will be the minus. So at the beginning, I had this money on my account. After that, I received this one and I paid this. Whatever is the difference, that should be on our account, isn't it? So can you find the difference? How much money still we have on the bank? Okay, so we can see how much it is. 83,456 plus 150, 300 minus 129,550. That will give us 104, 206. We're going to say 104,04206. And this is the money we have, so that will be debit on the cash book, because this money we still have on the bank account. All right, so let's move on. Let's move on to our next question we have. This one, they said calculating purchase as a missing figure. Calculating purchase as a missing figure. So we need to find the purchase. It's very simple. It's the opposite of the sales ledger control. On the sales ledger control, opening balance on the debit side. On the purchase ledger control, opening balance on the credit side. On the sales ledger control, bank or any payment is on the credit side. On the purchase ledger control is on the debit side. It's opposite, because purchase ledger control is a liability account. So we have a credit supplier. We have to pay this money to our supplier. So of course, if it is a credit supplier, it is our liability account. So let's have a look at that. Opening balance, we have 38,450. And the closing balance, we have 43,852. So let's write it down. Balance BD, that is opening balance. So 38,450. And the balance CD, other side, of course, that is 43,825. Now we need to see, is there any payment made during the year? So we can see this is called purchase ledger control. Payments made to credit supplier during the year was 167 from the bank and 430 from the till. This is the money we have paid. So if we paid this, we have to record on the debit side, because writing on the debit side, that means I'm reducing the balance. This is the money I'm supposed to pay, and obviously this is the closing balance. I already paid this money, so I'm going to say from the bank I paid 167,224, and from the till as a cash I paid 480. So if we paid already this money, obviously that will give me the purchase, the difference. So let's find it out. How much will be the purchase? So let's make it total and minus the other side to find the purchase. Because if I buy something, I have to pay more money. So I'm writing on the credit side. So adding 16, 167,224 plus 430 plus 43,825 minus 38,450. That will give you the balance. So let's find the total first. How much is the total? That is 21149. Okay, so 211,479. 211,479. And the balance CD, oh sorry, the purchase, the balancing figure, how much it is? Minus 38,450. That will give us the purchase. 173. Okay. 173,029. Very well done, Alicia. So that's how we can get our purchase figure. So this is the purchase. This is the missing figure. Exactly like a sales ledger control, just the opposite of the sales ledger control. Okay, so let's move on to our next question we have. We have activity 4. Let's have a look what is the question here. Calculating missing figure in general ledger account. This task is about incomplete records and restructuring general ledger. You are working on the accounts of a sole trader for the year end 31st of August 2009. The business is not VAT registered, so you don't have to worry about the VAT. Business is not registered for the VAT. You have the following information. Receipt and payment record in the bank account. Receipt and payment in the bank account. So we have received from the credit customer 50,000. We paid to our credit supplier 27,000. Interest received, we received 180. General expense, for the general expense we paid 7,700. Purchase of a new computer, we paid 600. And cash sale at banks, we received from the cash sale 14,440. On the other hand, we have some opening balance we can see. The opening balance we have for the trade receivables 10,000 opening, and the closing is 12,000. Trade payable opening is 7322 and the closing is 5322. Closing inventory, we have 9213 and 7321. Bank, we have opening balance 923 and the closing is 1723. So this is the information we have. After that, they said you are also told that all purchase of goods are on credit. So every single purchase you make, that's all on credit. And irrecoverable debt 210 was written off during the period. Remember, if there is an irrecoverable debt write-off, we have to make sure we write it off on the accounts. Irrecoverable debt means the debt is not possible to recover. Irrecoverable debt means the debt is not possible to recover. When you are 100% sure this money you cannot recover from the customer, we called it irrecoverable debt. Irrecoverable debt means I'm 100% sure this money I cannot get from my customer. So I have to write it off. So let's say this is my sales ledger control. So I have to write it off on the credit side, because writing the credit side, that means I'm offsetting everything. Then we have allowance for the doubtful debt 200 to be introduced. Okay, the proprietor draw £1,800 per month from the bank business account. £1,800 per month from the business account during the year. That means 1,800 per month times 12, that will give you the whole year, how much he take from the bank, because the bank will go down by this amount. Then he said the proprietor transferred her own vehicle value 11,000 to the business during the year. So this is the capital, isn't it? If the owner of the business give anything to the business of his personal asset, that will be calculated as a capital. If I'm the owner, if I give anything to my business, that will be treated as a capital. Computer costing over 300 are capitalized. Computer costing under 300 will be charged as the expense. Okay, so if any computer I buy, and if I spend less than £300, I'm going to charge this one as a general expense. I'm not going to capitalize it. All right, this is the information. Let's find it out. What is the requirement? The requirement here is find the credit sales. So they're asking how much is the credit sale. That one we already done before as well. So from the sales ledger control. And they give us the bank account as well. So on the bank account, they said find the amount of the loan repaid. So from the bank, whatever is the balancing figure, that will be loan repaid. All right, that's it. So let's do this one first, the sales ledger control and the bank. So let's start with our sales ledger control and the bank. First, start with opening balance, the sales ledger control. The opening balance, we can see we have 10,000. So we're going to say balance BD 10 to 53. It's the balance BD. Then you have balance CD. Balance CD, that is 12,442. So opening and closing is done. Then I want to see how much we receive from the credit customer. We can see we received from the credit customer 50,424. We're going to say bank 5424. And finally, there is a 210 irrecoverable debt. Yes, I'm not going to get this money. Irrecoverable debt. 210 pound. I'm sure like I'm not going to get this one from my customer. So this is not my customer anymore. I have to write it off. Write it off means I have to reduce the balance. So writing on the credit side means the balance will go down. So after that, I can find my credit sale. So added all of this, that will give us the total. So total is 63,076. 63,076. And if you minus that, that will give me my sales. So the sales will be 52,823. 823. Thank you, Asim. So we have this 52,823. This is our sales ledger control. So in the sales ledger control, we have some set information. You're not going to take more than that. So you have like opening balance, closing balance, bank, discount allowed, Then you have a sales return and and contra. That's it. You don't have more than that. So if you have something within this, you take it. If you don't have, you don't take it. On the other hand, the bank, this bank is all about the movement from the bank. So how much money you have on the bank at the opening. So you can see at the beginning of the time, we have a bank 923 pounds. So balance BD 923 pound we had at the beginning. After that, the closing balance, we have balance CD. So balance CD, we have 1723. And the question said from the bank, we'll find the loan repaid amount, how much loan we repaid. That will be our balancing amount. Let's have a look what's happening in the bank. So you can see from the customer, we receive 50,000. So if we receive the money, our balance will go up. So I'm going to write sales ledger control. We receive 50,424. So anything I receive, my balance will go up writing on the debit side. Then we paid something to the supplier. We can see 27,432. So we said purchase ledger control 27,432. This one we paid, so that's why on the credit side. Interest received. Interest received is income, so I'm writing on the debit side. Interest received because I received the money, so balance will go up. Then we have a general expense. Here's the money we paid. So general expense, we paid 7,700. Yeah. Then we have purchased a new computer. So it is more than 300. So we're going to capitalize it. So we said 700. So computer 600. Yeah. And is there anything else we missed? So we have balance, we have sales ledger control, interest received, then we have purchase ledger control. Then this, I think we missed the drawings, isn't it? 1800 times 12. How much is the drawings? Every month, the proprietor took 1800 pounds. So for the 12 month, how much he took? 21,600. Very well done. So we said drawings 23, 21,600. Okay. 21. That's it. After that, we're going to find our balance. After that, we're going to find the balance at the side, make the total. Oh, the cash sale. Do you have a cash sale? Oh, I missed it. Maybe where is it? The cash sale. Yes, 14,000. Thank you, Asim. So cash sale bank, cash sale banked. Yes, this one we received as well. That is 14,440. Yep. I think that's it. If the computer costs 250, would we be put on the debit side? Joseph, what happened? They're saying like if the computer is less than 300, you don't capitalize it. That means we don't treat this one as a capital expenditure. We treat it as a revenue expenditure on the income statement. But from the bank, money will go anyway, isn't it? So if the money is go, we record on the credit side. We never record on the debit side because debit side means I receive the money. Receive the money for any reason. If I receive the money, my balance go up. So recording on the debit side means money is in. Recording on the credit side, money is out. So it doesn't matter how much it is. As soon as money is going out from the bank, you have to record on the credit side. All right. Okay, the capital, we know the capital is basically, will go to the capital account. So when you make another account like capital, and that time, this capital will come here. That will increase the capital. But on the bank, actually, that will be not for the capital because if there is a capital, that will go to the capital account, not here. All right, so what is the total here? So the total we have here, 65, 967, 65,967. And how much is the balancing figure if we minus all of this? How much is the difference we have for the loan? So for the loan, we have 6912, 6912. Very well done. 6912 is the balancing figure. This is my loan. All right, so this is the one they're asking for that. So let's move on to our next question we have. Let's see what we have here. So if you read the question here, they said the proprietor transfer own vehicle at this to the business during the year. The question didn't say like actually you sell the vehicle and money come to the bank. So when you talk about the bank account, we only want to see how much you receive in the bank and how much is going out from the bank. So this could be like little bit like make you confused, like okay, the transfer of the vehicle. So that will be added on the capital 11,000, but this 11,000 actually never came to the bank. So my bank balance never gone up and down because of this capital. And this computer costing again is makes you little bit like confused because 300 or 200 doesn't matter. As soon as we paid for anything, that will reduce my bank balance. So it will go to the bank account anyway. All right, make sure if you have any question, ask me. We'll try to explain more. Okay, the next thing we have here, that is markup and margin. As we already discussed at the beginning, I'm saying again to all of you, margin is based on sale. Margin, the gross profit of sale. So margin is on sale. Margin is on sale. On the other hand, markup is on cost. If you remember this to your life will be very easy. So margin is on sale. So margin calculated on sales, but the markup calculated on cost. And after that, you need to remember margin means sales is 100%. So if I said margin, that means sales is 100%. Margin means sales is 100%. Markup means sales is 130%. It could be 135. Any if it is markup is 20%, then it will be 120%. So that means sales will be more than 100%. So I would say 100% plus. So this could be any person because in the exam, if the question is 20%, then our sales will be 120%. If it is 40%, 140%. So in the exam, if they said sales £100 and margin 20%, if they ask for the profit, how much is the profit? So what will you will straight away calculate the 20%, and I will say the profit is 20 because sales and the margin as link. Sales always go to the margin. Sales always go to the margin. But problem will happen when they give you the margin, but they will give you the cost, not the sale. So they're not going to give you the sale, they'll give you the cost and they give you margin. So margin and sale is from the different side. So margin always go with sale. So margin and the sale from the same team. But markup and the cost of goods from the same team. So when it is mixed up, so you have to change it. So if the question give like something this, we have to change ourselves. Let's have a look one of the example, then we might understand how can we change that. So let's move on to our markup margin. There's a lot of explanation you can read yourself that will help you to understand more. Okay, let's try this activity, activity 5. It said using margin to calculate the missing balance. WCO has a average profit margin 40%, profit margin. So margin is 40% and sales is 476. So we already know like margin always go to the sale. So our life is easy. Don't have to do anything. What is the cost of goods sold? So you already know that is very easy. Margin is 100%. So we said sales will be 100%. Then our cost will be 80%. And the profit will be, the cost will be 40% here, of course, because the profit is 40%. So cost will be 60%. And the profit will be 40%. That's very simple. So if my total sale is 476,000, and 60% of that will be the cost, isn't it? So how much it is? If the 60% is the cost, 476 times 60% is 285. So 285, 600. Thank you, Raju. And the profit will have whatever is the difference. That's the profit anyway. So this one, we don't have to worry about it. So this one, the question asking, so we can write it down here, 285, 600. So this is my cost of goods sold. Because it's easy, because we have a sale and we have a margin. So that's why we just calculate it straight away. So let's find the example. That one is a little bit tricky. Let's move to the next example. Let's have a look at this example. This example is saying, using markup to calculate a missing figure. Now we can see they give us the sale. They give us the sale and they give us the markup. And we know sales cannot be linked with the markup, so we have to change it. Now, when I have a markup, I know my sales is 30. So 100 plus 30 is 30%, 130%. So we're going to say sales is 130%, and it is a markup, so cost will be 100%, and the profit is 30%. Profit is 30%. This is the story. So sales is 130%. So 130% means the amount is here 221. This is basically inside of that there is 130%. So we have to find the cost and the profit. So let's find the cost. What is the question said? What is the value of the purchase? The question said the value of the purchase. So you have to use another formula. I'm sure all of you remember the formula. That is your opening inventory plus purchase less closing inventory. Your cost of sales formula. Cost of sales. If you don't remember that, write it down now. So the formula for the cost of sales is opening inventory plus purchase less closing inventory. Whatever is the amount will come here. This is called cost of sales. So if we know this is our sales, this is 130%. So 100% is the cost. So how much will be the 100% of that? Can you find the cost first? Cost of sales. So let's do this one first. 221 divide by 130 times by 100. That will give me the cost, isn't it? Because if I know 221 is the 130%, if I want to get 100% from them, that this is the way I can do. 221 100,000 divide 130 times 100. So that will give us how much? 170. Okay, this is my cost of sales. This is my cost of sales. So if I know my cost of sales, I'm going to write it down here. 170 is my cost of sales. And after that, I need to find my opening inventory. The question said opening inventory is 43,000. So I'm going to write 43,000. The question said the closing inventory is 47,000. I'm going to write 47,500. That's the minus. And the balancing figure will have the purchase. The balancing figure will have the purchase. Can you get the purchase? How much is the purchase? So we have 170 cost of sales. Closing is 47,500. And the opening is 43,000. Now, if you want to get it, remember, if you want to go from the back, you need to do opposite. Normally, when you come from the top, so we said 43 minus 47,500, then this will give this figure. But when you go from the bottom, you do opposite. So you do 170,000. This is minus, so you make it plus. So you said 47,500. This is your plus, you make it minus 43,000. And whatever is the figure, this is your balancing figure, purchase. How much it is? Can you get the figure? So we have 43. This is 174,500. Okay, 174,500. So 174,500. This is my purchase. Now have a look. If you have this figure 43,000 plus 174,500 minus 47,500, it will give you exactly cost of sales. But when you go from the bottom to top, you do opposite. If something is minus, you make it plus. If something is plus, you make it minus. Because if you go from the bottom to top, top to bottom is normal, minus is minus, plus is plus. But bottom to top, you do opposite to find your missing figure. So this is the trick here. So this type of question can come in the exam. So if this type of question come in the exam, all you have to remember, you have to make the separate of the cost, because I know it is a markup. That means this is 100 and the plus profit percent. So 130 is the profit. So 130 is the profit percent. So inside of this 2 to 1, it is 130%. 100% is the cost, 30% is the profit. So if I separate the 100% from here, this is the way we do. 2 to 1 divided by 130 times 100, that gives me 170. So 170 is the cost. Then I use my cost of sales formula. Cost of sales formula is opening inventory plus purchase less closing inventory. So out of this 4 information, I have the opening, I have the closing, and I have the cost of sales. I need 1. Remember, if there is 2 things missing, you cannot get it. If 2 information missing, you cannot get it. You should have 1 information missing, because 1 information is the balancing figure. If you have 1 information missing, then you can get it really easily. So if it is from the bottom, you need to do the opposite. If something is minus, make it plus. Something is plus, make it minus. Other than, it is not very difficult. It's just a plus and minus. All right, any question from here before we move to the next one? All right, very good, very well done. As I said, this chapter will be like the tricky chapter from the whole book. Other chapter you will find really easy, to be honest. Like only the partnership may be a little bit tricky, but any chapter will be really quite straightforward. Okay, the next chapter we have the accounting equation. I'm sure all of you remember the accounting equation. That is asset equal basically liability plus capital. So if I added my capital and the liability, that will give my asset, isn't it? For example, if my asset is 100, my liability is 50 and the capital is 50. So in the exam, they might not give you 1. So they'll give you 1 missing. Let's say they'll tell you how much is the capital. So 100 minus 50, so capital will be 50. Maybe they're not going to give you the liability. They'll say asset is 100, capital is 50. How much is the liability? So 100 minus 50 is give you the 50. Maybe the question said they don't give you the asset. They'll tell you the capital is 50 and the liability is 50. How much is the asset? We need to add it. That means 100. So asset is the total. Asset is the total combination of the liability and the capital. So if I added capital and liability, that will give me the asset. Anything missing, if I have 2, I can find the third one. So if you remember this one, asset equal liability plus capital, you can find anything. So obviously, the question will give you something missing. You can find it out if you know this accounting equation. Let's have a look at one of the example. Let's see if you can do it or not. Okay, this is one of the accounting equation. It's a little bit long, but it's not difficult. They asked to complete the accounting equation. They said how much is the asset, how much is the capital, how much is the profit, and the minus drawings, and how much is the liability. So all you need to do, you need to follow these steps. So let's have a look. Start with our asset. Let's find how many assets we have. So assets and liability is to our main. Okay, the first thing we have, let's do it together. Plant and machinery. Plant and machinery is our asset. So plant and machinery, we're going to write on the asset. So 10,000. Then the next one we have motor vehicle. Motor vehicle is our asset. So motor vehicle is our asset, 5,000. Then capital will go to the capital, so we don't have to worry about it. Trade payable. Trade payable is our liability. Trade payable. Trade payable means the supplier, credit supplier, 3,000. Trade receivables. Trade receivables means sales ledger control. Trade receivables means sales ledger control. We said sales ledger control. This is our 2,000. It's our asset. Then drawings. Drawings is a drawings. When owner withdraw any money from the business, we call it drawings. This is not an asset, this is not a liability. Inventories. Inventories means stock. So for example, if I make some product, if I cannot sell everything, whatever is the leftover in the stock on the warehouse, we called it inventory. So this is our inventories. 4,500. Then accruals. Accruals is a liability. Accruals is always liability. Accruals. So I used the services, but I didn't make the payment. For example, I used the gas and electricity for the month of December, but I didn't make the payment until I received the bill in January. So this is our accruals. Bank is the debit. So bank debit is our asset, isn't it? Bank debit is our asset. Then we have a cash. Cash is also asset. That is 250. And I think that's all. So okay, so let's add this one. Let's all add the asset. So can you add all of this and find how much is the asset here? So added all of this, 10, 5, 2,000, then 4,500. How much it is? 25. Unless the question said is accrued income, we know you need to understand this is a liability. For example, the VAT, for example, the rent. So if you see the rent is the expense, if you see the VAT is a liability. So 25, 250, 250, okay. So I'm going to write 25, 250. And how much is the liability we have? 3250. So liability we have 3250. And the capital, we have only one capital, that is 20,500. So we can easily write that. There is no problem for that. 20,500. Then we have a little bit profit. The profit we have 3,100. And the drawings we have 1,600. That's it. So that's this type of questions sometimes come in exam. So if you remember your accounting equation, but in the exam they'll tell you something, you have to find the missing one. But if you remember the asset you call liability plus capital, you can easily solve this question. All right, so let's move on. The next question we have the capital account. Let's try this one, everyone together. Let's try this. So this question is said missing balance and the accounting equation. This task is about calculating the missing balance and the accounting equation. You are given the following information about a sole trader as at 1st September 2008. A sole trader started a business. Okay, the business was not registered for the VAT, so we don't have to worry about the VAT here. The sole trader transferred 15,000 of her own money into the business bank account. So this is the capital, isn't it? So if you introduce any money of your money into the business account, this is your capital. 600 was paid from this account for this computer. Remember this one. 600 was paid from this account. This account means business bank account. So that means this is not your again capital. Don't think like 600 maybe the owner paid and this will be part of the capital. Actually, it is not. 600 is paid from the business account. So this is not your capital at all. Goods for the resale by the business costing 1,400 were purchased using the trader's personal bank account. So you use the personal bank account. That means 1,400 again is a part of the capital because the person who using his personal bank account. So when the owner buys something by using his personal bank cards for the business, this will be added on the capital because this is not for his personal use. This is for the business. So that will be the contribution towards the business. So that will be the part of capital. So let's complete this question. So opening balance, we don't have any opening balance. The opening capital is 0. The next one we have bank. How much you deposit to the bank? 15,000. First question is 15,000. We deposit to the bank, and again we put 1,400. I buy something, isn't it? So I purchase. So I said purchase 1,400. Even though he didn't deposit the money to the bank, but it is still part of the capital because he used his personal money to buy something for the business. Okay, so how much is the total here? 16,000 and 1,400. And 16,400 is my balance CD. Balance CD of the capital, 16,400. That's it. That's very straightforward and easy. So I'm sure all of you know this thing. This ledger account is not something very difficult. Let's try this question together. It says, the following day, the trader made her first cash sale. A profit was made on the sale. So try to understand. The following day, next day, the trader made her first sale. So the businessman who make a sale, he makes some profit. So what happened after that? This profit was made on the sale. The receipt was banked, and the transaction entered in the record. So what will happen on the accounting equation? So when you make a profit and deposit into the business bank, what actually happened? Check the appropriate boxes to show how this transaction affects the element of the accounting equation below. Asset, liability, and capital. So if you if you deposit any profit into the bank, what will happen? So asset, it will increase, decrease, or it will have no change. What do you think? So it will increase, of course. Very well done, all of you. It will increase because if I deposit any money into the bank, obviously it will increase the asset. The next question is, what will be the liability? What will be the liability? It will increase, decrease, and will have no impact. So the liability have no relation. The liabilities only happen when I take the loan from the outside people, or if I pay off the loan. So that time liability go up and down. This one have no relationship with the liabilities. I would say no change. What about the capital? The capital increase or decrease or no change? Increase. Very well done. Because the capital is the part of profit. So if you remember your capital equation, it said opening capital, then plus profit, then less drawings. That will give you the closing capital, isn't it? So if I have a profit, opening capital, my profit always increase the capital. Remember that. Profit always increase the capital, and drawings always reduce the capital. Profit always increase the capital, and the drawings always reduce the capital. So if the capital is, the profit is increased, then the capital also increase. Okay, let's move on. The next one we have, what else we have? They said you are giving the following information about another sole trader. The cash book show a debit balance 4250 and the bank statement shows a credit balance 7,500. That's a bank reconciliation, isn't it? The bank reconciliation. I'm saying I have 4,000 pounds and the bank is saying no, you have 7,000 pounds. So my record and the bank record is not matching. I'm saying I have only 4,250 pounds, but the bank said no, you have 7,500. Bank said you have more money. So what is the reason? What is the explanation we have for this difference? It said direct debit on the bank statement have not been entered in the cash book. Check to supplier sent out at the end of the month have not yet cleared. A receipt from a trade receivables has been posted to the bank account in the general ledger twice. What do you think? So this is the reason, isn't it? Check we give to our supplier, but they didn't go to the bank. This is called unpresented check. If you remember your bank reconciliation, unpresented check. Unpresented check means I give a check to someone and this person didn't go to the bank. So if I give a check to someone, I already minus this amount from my book, but he didn't go to the bank yet. So that's why the bank didn't clear the balance yet. So bank said you have more money, but actually I don't have because I already minus it from my balance. That's why my balance is showing less and the bank said I have more money. All right, so let's move on to our next point. This is the balance of the preparation. This is again for our accounting equation. So let's try that. Accounting equation. So they say this task about calculating the missing balance and preparation of the final accounts. You have the following information about sole trader, planted carrying value, that's the asset. Inventory is the asset. Bank, debit balance on the bank statement. This is the trick here. So bank said debit balance on the bank statement. Normally, if it is a bank is a debit balance, you understand this is our asset. But it said debit balance on the bank statement. What does that mean? Debit balance on the bank statement. So I received the bank statement. Normally, my bank supposed to say this is the credit, not debit, because it's debit for me, it's asset for me. But from the bank point of view, this is the liability, isn't it? Bank cannot say this is their money because bank holding my money. So from the bank point of view, it is the liability because bank should pay my money back. So bank should say that's my liability. But if the bank said this is a debit, that means this is the money I have used extra. So I'm using the bank money. So this could be loan or it could be overdraft. So I'm using more money that I have in the bank. I cannot say that's my asset. That's my liability. Because if it is my asset, on the bank statement, it definitely show credit balance, not debit. Because sometimes when you call, like if you try to call to someone, sometimes your phone said you don't have enough credit. That means the credit you don't have. So credit means a liability for them, not for you. So for you, everything is debit. For them, it is a credit. Trade payables, this is our liability. We know it. All right, so can we do that? Our calculating the following balance at 1st May, do not enter the negative figure. So asset, how much the asset we have? Can you do that? The asset we have here, that is 81,500. Then the liabilities, how much is the liabilities we have? 19,300. And the capital, how much is the capital? So you see, I now have asset, I have a liability, I don't know my capital. So if I don't know my capital, I can find it out, isn't it? So the difference between these two will give me the capital. 62,200. Very well done. Very well done, Hemant. Very well done, Julia. So we have the right answer, all of you. So let's move to our next question we have. All right, the next question we have here. So we have again the markup. During the year ended 30 of April 2005, sale of 47,450 were made. So sales is 47,450. The trader operated markup. So markup means is 100, more than 100%, isn't it? So when I have sales 47,450, that means here I have 130%, isn't it? So I have to find the cost. How much is the cost? Is 100%. So we know how to get it, isn't it? 47,450 divide 130 times by 100. This will give me the cost. Anyway, we don't know what the question asking, but we are just guessing that will be happen. Calculate the cost of goods sold. Oh, they're asking for the cost of goods sold. All right, so we can know how to do it. So 47,450 divide 130 times 100. So that gives me how much? 36,500. Very well done, Mark. So 36,500. Yes, this is our cost of goods sold. The next one, they said purchase for the year 48,000. Calculate the value of closing inventory. Now I have to go back to my previous formula, that is opening inventory plus purchase less closing inventory. That will give me the cost of sales. So cost of sales I already know, that is 365,000, 36,500, sorry. Then we have a purchase, we already know the purchase. The question said 48,500. So we don't know the closing inventory. The opening inventory, the question already given in the question. Let's have a look. How much is the opening inventory? They said asset and liability as at 1st May. So at the beginning of the period, so opening inventory is 10,000. That's fine. So let's find our opening inventory is 10,000. Can we find our closing inventory from here? So how do we get it? So it is 22,000. Well done, 22,000. If you minus, this should be this amount. So this plus this minus this, it should be give you 36,500. All right. So our closing inventory value is 22,000. Okay. So let's move on to the next question. What we have here. Say the trader now tells you that during the year he has taken some goods for personal use. If they take some goods from personal use, we know it is a drawing. So this said, this means that the inventory figure in the final account, 30 of April 2005, will be greater than or less than or same as the figure calculated in C. So after we calculated, we have 22,000 pounds for the closing inventory. The owner of the business who took some inventory for his personal use. So it will be what? Less than, same as, or greater than? That will be our less than, isn't it? If we take something from here, after I calculated the closing inventory, if we took something from there, so my total inventory figure will go down. All right, so let's move on to the next one. The next one is says, which of the following is the best described as a current asset? I think all of you can do it. Let's quickly have a look. So what is the current asset? There's a bank overdraft, drawings that the owner has taken during the year, money owing from credit customer, money owing to credit supplier. So which one we think is a current asset? So current asset is money owing from the credit customer. So when you make a credit sale, and we expect the customer going to pay us, this is our current asset. Sales ledger control, trade receivables, they are my credit customers, so they are my current asset. All right, let's move on. I think this is the end of the chapter. So you can see like we have done practice almost every single activity we have in the book. But as I said, this is the trickiest chapter from the whole book. If you tell me which one is the more tricky chapter from this book, from this course, chapter number 2, incomplete course, and that one will come almost 30 to 35 marks. So I'm expecting all of you to revise this chapter once again. If you need to watch this recorded lesson, you can see it again. There is no problem for that, but obviously you need to make sure you revise this chapter once again. And if you have any question,